North Dakota State Extension economist Frayne Olson is our market analyst this week. The USDA believes the country's growers are harvesting a record soybean crop this year and the third largest corn crop in history. The agency's November crop report released Tuesday made increases to average yields and overall production in both corn and soybeans. Nebraska farmers, meanwhile, are expected to set new records for the state in corn and soybean production, as well as average yields for both crops. We talked with Frayne Thursday morning and started by asking for his thoughts on the latest round of crop estimates and supply and demand numbers.
Well, obviously the general consensus was it was negative. I guess the big changes that USDA made, the surprise I think to everybody was the soybean yield number. The trade was expecting an increase in yields, but it came out a little bit bigger than expected. So we added about a little over a bushel to this average soybean yield. We added a little over a bushel to the corn yield. And they made some small adjustments on the demand side, the usage side. For corn, we actually took total usage down. They trimmed the ethanol number. They trimmed the exports number. Slight increase in feed. On the soybean side, again, we took yields up pretty significantly. They did increase the expectations for crushing demand as well as exports, but not nearly as much as we increased the production. So in general, the report was negative.
As you mentioned, the USDA lowered that ethanol number by 75 million bushels. Can you explain more about why they did that?
Well, I think there's two things going on. Number one, we've got lower gas prices, and so as a result, ethanol prices need to stay in a price relationship to gasoline. And again, that's going to put some profit pressures on the ethanol industry. We're also seeing some substitution for sorghum into the ethanol sector that's bumping some of the corn numbers. So, you know, with the lower prices, the ethanol industry is really hoping for people driving more, getting more mileage, driving more miles, using up some more gasoline, of course, blended with ethanol. There is a potential for some increased export demand on the ethanol side. We've seen a little bit of that occurring already. But again, given the high value of the dollar, that's going to be a pretty tough deal to do.
Well, it also made reductions in corn exports. What are the things playing in there?
On the corn export side, again, some of that I think is strong competition we've had on the world stage. We're also seeing a pretty good export pace for DDGs, which again is a substitute for corn in the world market. And then finally is just the world economy is slowing down a bit. I mean, we've been struggling on the demand side to be able to sell our products. China is talking about making some changes in their domestic policy to take some of their grain out of the government-owned reserves, again filling the market domestically in China with more domestic corn, and with that then it's less demand on the international market for U.S. corn. So there's several headwinds going in the exports area.
If you look at the weakness in exports, you go over to wheat. They lowered that by 50 million bushels to 800 million bushels. How low is that?
Well, we haven't seen those. We have to go back to 1971 to find numbers that are actually lower than that. And that's, again, pre-Russian wheat deal. So it's been a long time since we've had this low of export expectations for wheat. Again, the big headwinds that we've got in the export market, large world supplies, strong U.S. dollar, which again makes our grain very expensive internationally. And in particular, the Black Sea region, both Ukraine and Russia, have been really the low bid pricing system in the world market. So they've been able to steal a lot of the market share from the U.S.
How negatively did the markets react to these overall numbers?
Well, we essentially went down on the futures market. We went down and touched the levels that we saw in mid-August. And fortunately, those levels held. It looks that at least towards the end of the week now, we're getting a slight rebound, which in my view is a strong indicator that, you know what, the buyers in the world market and domestically feel that these price levels are a good buy. They're trying to come in and buy at these levels, but again, farmers are holding really tight, and so we're seeing some of the basis levels start to improve. So it's now a waiting game. It's kind of a game of chicken between the buyers and the farmers on when they need to sell.
When we talked in September, Frayne, you thought that it was going to be a tough go for corn and soybeans during harvest. Now that we're through and we look at those magical levels of $4 and $9 for corn and soybeans, how long do you think it takes us to get back to those numbers?
Yeah, I'm afraid it's going to take a while, given the new information we got from USDA, and again, the market's going to digest all that and kind of sets the expectations. It's going to have to be something pretty substantial in order to start lifting prices. So my expectation, my best guess is that we're going to see these relatively low levels bouncing around in a fairly narrow trading range, really until, I'm guessing, until mid-January. Unless there's some really problems or challenges in finishing up the South American soybean plantings. If there ends up to be some weather problems, that could spark things. But we really need to get into January before the South American crop is developing enough that we start getting into more of a weather market based on South American production.